Hi, it's Richard Hemming here from Under the Radar Report. I'm here with Chief Investment Officer of Cuttable, Richard Bailey. How are you?
Hi Richard, how are you? Nice to be here.
Well, it's great to be here. We're doing talking stocks. We're going to be doing this regularly. We're going to be starting off talking about the market quickly, then getting to those all-important stocks. And what a week. I mean, this is the week to talk everything investments, because it's not often you hear about a downgrade of the US economy. And we got that this week. But I guess what's more interesting for us is the upgrades and more that we're seeing with small caps, like 50% plus. I mean, we've had Pacific Current taken over, some like Red Bull, no announcement at all. I mean, it really is, some of these stocks are bouncing aggressively. Rich, do you think this kind of activity is going to continue, especially with the reporting season coming up? And, can you invest anywhere else other than equities?
There's no rules, Richard, but equities.
There is
Small
no
cap equities. Don't even bring the talk of anything else into the room, please. Well, some of the bounce you've seen is from stocks that were sold down, perhaps excessively, depressed levels, end of financial year tax.
Yeah.
Getting ugly ducklings out of the portfolio, that type of thing.
Yeah.
And there has been a big bounce, 50% say, but that's good. Not so good if you bought it $1, went to 20 and went to 30. It's an improvement, but it's not necessarily making you the fortune. But it's been good, and there's been some positive trading updates, or some trading updates that are not as bad as feared.
Yeah.
There were some updates leading into the end of the financial year where companies were saying, well, trading for the last 2 months has been tough, and if we don't have a good June, then it's going to be even worse. And so some of that detail's been fleshed out now. And some of it's not as bad as feared, and there's been a bit of a bounce.
I think exactly, and I think what we saw was certainly an element of flood of capital out of small caps going to the blue chips. And like if a small cap didn't say anything, it was like, oh, well, there must be a problem. And now suddenly that they're saying something, all that pessimism that's been priced in, there's a release in that, now there's more optimism. Yeah. We've got a glass that's half full.
There is, but sometimes saying nothing's actually been positive too, because if a company, stock's trading like there might be bad news, the company comes out and says, oh, we're going to release our results on the 15th of August, and they say nothing else, everyone goes, woof, there's nothing bad to say, it can't be that bad. Stock starts to rally.
Well, we'll see what happens this month. There's going to be a plethora of companies reporting. Speaking of which, let's get on to the stocks. The first one I want to talk about is called Beamtree. This is definitely under the radar. So Richard, you might not have heard about it. It was called PKS. What we like about Beamtree, 60 million market cap, so in our sweet spot. Basically, they're in health analytics. So there is huge demand for health analytics. These guys have a big customer base, around 22 countries. Their software in different hospitals around the place, from Saudi Arabia to the US to here. But basically, they look at data, they analyze it, and then they provide clinical outcomes for the clinicians, or suggestions. What they have is a deal with Abbott Laboratories. That means that they're really is supercharging their license growth. So I guess what we're looking at is a stock that's going from being marginally profitable to one that, if this kind of revenue run rate continues, can be really profitable. That's certainly a stock that we're interested in.
Yeah, I'd be interested to see what sort of margin they've got to give away to Abbott in order to do the distribution. It's a distribution agreement, presumably. Yeah,
it is. They get a share of the profits, I think.
Yeah. Oh, that's interesting. Well, there's a few other stocks in that space, not directly in that space. Max 7 Tech, you may have.
Yeah.
Well, the big brother is Pro Medicus, which most people have heard of. It's been an excellent performing stock, and it's not exactly the same as Max 7 Tech, but it's in a similar space, helping radiologists view scans. And as the US government has made it mandatory for health records to become digitalised, companies like Max 7 Tech are now starting to pick up
more and more traction. It's been a slow burn. It's like some of these companies, it's not one deal, it's many deals. They're starting, because they're software as a service, so they're getting that, they're building up that income, and the churn rate's probably pretty low.
Churn rate's pretty low, and they've picked up, I think, their largest contract recently with Veterans Health. So they're starting to get some traction, bigger contracts, getting more scale. And then, unfortunately, they came out with a bit of a disappointing cash flow update a couple of days after that, but timing issues. There's been a bit of a slowdown in the sort of rate of revenue growth, but with those new contracts they've announced, that should wash back out in FY24 and FY25.
Well, they don't have much fat, do they? Some of these small companies like like one company that we cover, like let's keep on this sort of software as a service bent, like Catapult.
Oh, yes.
What's interesting about Catapult is just the sports teams that they're involved in. They're in sports analytics, and this company had all sorts of trouble trying to hit the so-called prosumer market.
Yeah.
But they had a guy come in that was ex-Amazon, sort of cut costs, and now you're starting to see some, real, I guess, well, the stock's almost doubled in 5 or 6 months since we tipped it. This doesn't always happen, by the way, but definitely we're seeing a situation where stocks that were just ignored during that time, a few, like 5 months ago, now suddenly people are starting to think, well, maybe they're going to get the growth that we want.
Yeah, well, they've pretty much saturated the professional market, haven't they? Their devices are ubiquitous, but I guess adding more services to that offering, trying to get squeeze more out of the pip, I guess, with each team they're associated with.
Yeah, well, they've definitely got a big umbrella approach in there. But the point is, I guess, is that their unit costs are lower while their revenues are managed. So they're managing to improve their margins, but they've still got like huge depreciation costs. So we can't actually see them being profitable anytime soon.
So Rich, as we know, there's been markets up and down. Everyone's worried about interest rates, so they're going higher. Are they not? Are we getting a recession in the US? We're going to have a recession here. Stocks are waxing and waning. And we know that the consumer's been feeling a pinch, and we've seen that in the retail stocks with tough trading conditions. But there's some light in there. There's some flip side too. I mean, Kogan had a trading update recently, last week I think, and they mentioned that, well, one, they had a huge inventory build previously. They overstocked during the tail end of COVID, and they had to clear through all that and kill their margins getting out of the stock. Got out of that stock now. They've been collecting a whole lot of cash. Consumers still struggling, but you see companies like that where they've turned around the sort of problems they've got within their business. So they've done what they can do, and it's now a matter of whether can the consumer kind of keep spending. And
well, the retail's always an interesting sector, isn't it? Because you have that kind of leverage, and you've got that database that Kogan has that's almost unparalleled in the Australian market. But it's very much a timing issue we've found with Kogan. So we've stepped on, we got onto it at the right time. But just staying on the Kogan bandwagon is the question is when to get off, because it's just such a cyclical business. Like one that's in that same position is City Chic. Like they've had that inventory overload, but their model's a lot harder to fix. So it's kind of subdued. Whereas you would think that.
Yeah, City Chic will be interesting to see what they say.
It will, we're sort of holding.
The stock I noticed is moving up a little bit from press levels.
Definitely.
But, is that too soon to have a look at that?
Yeah, I mean, I would say that we're kind of moving our portfolio away from retail at this point, just because it's so high risk. But definitely, Kogan is one of our favourites in the sector.
Yeah, but on the consumer, we saw Credit Corp come out with their result. They're always the first company to release their results. So usually, 1st of August, bang, they're out.
Yeah.
Then if you don't know, they buy delinquent loans from banks and then go and collect that money. And they were saying, well, a couple of things. One, there's been a few ledgers to buy because the banks aren't having to sell the loans yet because they're not going sour. Bit of a hangover from cash handouts from COVID plus forbearance, and then also people take money out of their super, so the consumer, those customers have been able to maintain repayments. So
we're seeing savings rate go up, and that's
so those ledgers haven't been sold yet. So Credit Corp has had slower growth because there's no books to buy.
So is that do you think that augurs well for? I guess that means that people are not quite as aggressive as in previous times in the cycle.
Well, it either means they hang in there or the penny's the shoe's about to drop with the step up in interest rates coming.
I think the property prices would sort of kind of mirror where people's optimism lies. Yeah. That's across the board. I mean, I think when it comes to equities, one of the big points we could make is that there is more flexibility on getting into and out of equities than other markets. Like at the moment we're seeing it's very difficult to get out of property, whereas equity, there's more flexibility. You're getting dividends. While there is a depressed sort of aspect to the economic times, it's also what you're paying for that. And I think the prices, certainly in small caps, are still at value prices. So that's why we're pretty optimistic.
And stocks are moving too. Like another one, EOS. which has had a checkered hard past. It is gun turrets basically for tanks and other armoured vehicles.
Oh,
They had a long history of, well, I don't know about long history, but they overpromised and underdelivered for a couple of years. Promised all these earnings which didn't arrive, raised capital, built up huge inventory balances, weren't able to collect on debts from their customers.
What do they do exactly?
Well, they make weapon systems.
Oh, right.
Right, and so there's a Land 400 program in the Australian government is replacing a whole lot of their army fighting vehicles.
Yeah.
And Hanwha, with South Korea, a defence contractor, have picked up a contract to build those vehicles, and
Oh, right.
EOS will supply the gun turrets and weapon systems for those vehicles. That's just part of what they do.
And how big is it?
Market cap?
Yeah.
Oh, you're testing me.
About
300 million maybe?
Yeah, it's pretty big, yeah.
Might make a liar of me.
Yeah.
But anyway, they've finally started to collect on some of I think they've had to take a haircut, but they've started to collect on some of their bad debts. Ukraine is seeing a boost in demand, so they're selling a lot of equipment into Eastern Europe. It might be turning around.
Yeah.
Once bitten, twice shy, but I've dipped the toe in, shall we say. Yeah,
Yeah.
having been disappointed in the past, it does look, new management, the cash flow is picking up. It means a long way to go.
Yeah.
Be keen to see what the numbers look like in the result coming up, but
Yeah,
it's
well-
like it's starting to move a bit too. It's just getting away from the
Yeah,
consumer, more
well,
government,
exactly.
government
Yeah.
customers.
Well, there's one stock like in that kind of vein that we've covered forever, Quickstep, and they do like they have this carbon fiber technology, and they're involved in defense as well, like a big supplier of tail fins for the Hercules, I think, to see. Well, they were the Joint Strike Fighter, but basically, this company's now, using their technology in the drone sort of area. All these companies in this wholesale area where you've got a good defence contract, it does provide that certainty that's not available elsewhere in the consumer sort of side of things.
Yeah. Well, speaking of aircraft, another one that's had a leg up is Alliance Aviation.
Oh,
You may
I've been long
Long
supporters of
long
Alliance.
support of Alliance. They've renewed their contract with Santos again
Yeah.
for another 5-year term. They're leasing more wet lease aircraft to Qantas. The deal with Qantas got knocked back by the ACCC. They were going to
Yeah, I
tie
think
up,
it's been reviewed, but yeah.
but they're still leasing aircraft to them.
But it's still a good stock, so
And they're replacing all their Fokker aircraft with the Embraer E190s, E130s. So there's been a very big capex program.
Yeah.
They have geared up the balance sheet, but that should then start to. I think we're getting towards the end of that. They bought some more aircraft frames recently, but once you get through that capex program, then you should start to see the cash flow. Really improve.
like that's exactly what we're thinking. I'm thinking that stock is one company that won't need any cash anytime soon, because a lot of the future cash flow is baked into the deals that they've done. And I think, look, I mean, we could talk stocks forever, but I think the big takeout is there is no other place than equities to be. Thank you, Richard, for joining me on
Nice to be
Taking
back
Stocks.
in a month's time, we'll have a whole lot more news, having got through reporting season.
There's never a shortage of news,
No.
and we look forward to talking to you guys again. Thank you.
Thanks.